The Russian economy is currently facing significant challenges, with the government limiting the release of economic data to the West, citing security concerns. However, some data, including interest rates, inflation, and the value of the Russian ruble, is still available. Here's a summary of the key points discussed in the provided text. Interest rates. The Russian central bank has significantly increased interest rates, with 3 hikes in the last 2 months, moving from 7.5% to 13%. The official reason cited is to combat inflation, but the current inflation rate doesn't seem to justify such steep increases. Inflation. Russia's inflation rate is relatively moderate compared to some G20 countries, at 5.2%. The sudden and significant reduction in inflation in March 2023, from 11% to 3.5%, is considered unusual and is not easily explained by available data. Russian Ruble. The ruble has been consistently declining in value. It passed a landmark figure of $1 to 100 rubles, prompting immediate intervention by the Russian central bank. Despite the intervention, the ruble continues to face pressure, and its value is deteriorating. Balance of trade and current account. Russia has experienced a significant fall in its balance of trade over the last 18 months, with current levels being the worst since the COVID-19 pandemic. The current account has also been reducing in value every quarter for the last 12 months, reflecting the impact of sanctions and fall in income. Economic strain and sanctions. The sanctions imposed due to Russia's actions in Ukraine are having a substantial impact, causing large deficits and reducing Russia's income from exports. The National Wealth Fund is currently covering these deficits. The sanctions and the war effort in Ukraine are straining the Russian economy, manifesting in the devaluation of the ruble. Conclusion. The recent increases in interest rates by the Russian central bank appear to be more related to bolstering the ruble and addressing economic problems, predominantly caused by sanctions, rather than combating inflation. The inflation rate is currently at a manageable level compared to other economies around the world. The sanctions and the ongoing war effort in Ukraine are causing significant economic strain, leading to large deficits and a risk of running out of cash. Impact of interest rate on currency. While higher interest rates typically attract more investment into an economy, bolstering its currency, the ongoing geopolitical situation and sanctions have made Russia an unattractive investment opportunity for many countries, limiting the positive impact of interest rate increases on the ruble. Overall scenario. The data available does not support Russia's narrative of being unaffected by sanctions and being able to pivot its trade to other countries like China and India. The economy is showing signs of significant strain, with emergency measures being implemented, and the value of the ruble continuing to deteriorate despite interventions.